Today on Escape the Clock, we're aiming to answer the question, if you and a Wall Street insider make the exact same trade, why does Wall Street almost always win? Most of us learn the rules. We know to buy low, sell high, diversify, and to try to avoid panic selling. And once you know the rules, you can play the game. In a good year, you might even match the market. But there is one thing most investors never stop to consider. On the other side of every trade you make, there's someone else. A lot of that time, that someone is a professional with tools you don't have and a playbook you've never seen. Researchers at MIT and Stanford studied more than a decade of everyday investors trading options around company earnings. They found that regular investors lost money on those bets, and a big share of the loss was the spread, the hidden cost of the trade itself. About 9 to 10% of their money was gone. So who is on the other side of your trade? What did they see that you don't? Today's guest spent years finding out. He learned to trade in college from his roommate, mostly by guesswork, watching strange moves in the market that he couldn't understand. Then a seat at Merrill Lynch put him on the inside, the clear view of what the big institutions were really doing, but the rest of us were doing wrong. Now he teaches an audience of more than 80,000 investors how to trade with professional discipline. So today, get into what insiders actually know, how the pros decide when to buy and when to sell, and why so many retail traders read the market's biggest signals exactly backwards. Stay tuned to learn how the insiders trade and how to stop being the easy money on the other side. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. Most of us come to the stock market in the same way. Our employer opens an account on our behalf, or someone mentioned a stock, like the market might have had a great year and we don't want to miss out on the next one. We learned by doing. We made some money, we lost some money, we developed opinions and instincts in a general sense that we're figuring things out. But here is something most retail investors never stop to consider. On every side of every trade you make, there's someone else. And in many cases, that someone else is an institutional trader who does it professionally, who has access to tools that you don't, who's operating from a playbook that you've never seen. 80% of day traders quit within 2 years, not because the market ran out of opportunity, but because they were consistently on the wrong side of that equation. The institutional edge is real. The gap between how professionals trade and how retail investors trade is measurable, can be significant, and it's rarely talked about honestly. Today's guest traded professionally at Merrill Lynch and Morgan Stanley before walking away to teach retail investors what he saw from the inside. Scott Curry is a former investment banker with over 25 years of professional trading experience. Known as Stock Curry, he has built a YouTube community of over 80,000 investors and generated more than 6 million views teaching retail investors to trade with professional discipline. Scott, welcome to Escape the Clock.
Thank you so much for having me. It's a pleasure to be on, and I can't wait to share some of the insights that I experienced working at Merrill Lynch, Morgan Stanley, and other investment banks, and some of the differences in how retail traders trade, as well as a lot of the advantages that institutions have. Good news is a lot has changed over the last 5 years or so. Retail traders have access to a lot more tools these days, and we can get into a little bit on that so that we can help you, the listener, to become a better trader and make a lot more money.
I'm really excited to learn from you here because I know you spent decades really learning and mastering this and teaching. So what did you see that retail investors might be getting wrong that you feel that you had something worth starting to share out with everybody?
For me, it all started back in 2000 when I was trading on my own. I was learning how to trade from my roommate in college. And at the time, it just felt like a lot of guesswork. And I was seeing these weird things in the market where I would do something and then some large trade would come in and kind of mess everything up. I couldn't quite figure it out. In 2008, I had the opportunity to go work for Merrill Lynch. And that is when my eyes were opened, because suddenly I could see everything that was going on. And the real benefit for me is I was actually working in the back end. So I had full access to the DTCC and all of the dark pool trades. And I could see what every single institution was buying and selling. I could also see what the retail traders are buying and selling through Apex Clearing. And I had access to see what our firm was actually pushing out to the individual investors on the financial advisory side of the business as well. And so it gave me a lot of insight that most people never get to see. Even the traders themselves don't get access to all this information. And through that, I learned some really big differences between what institutions were doing and what retail was doing. But I think the biggest difference of all for me at that time was seeing how the firm would take their research and their analysis that Merrill Lynch got from BlackRock and other investment firms, whether it's Vanguard, Jefferies, we all do our own research. And the firm itself would use that research to place their trades. Then they would give that out to the financial advisors. The financial advisors would then push those stocks to their clients, and then the firm would turn around, sell, and take profit. You know, you can call it unethical, whatever. That's just one of the many ways that it works. And there's all of these little inside things that I learned about. And it made me very quickly realize that if I was going to make money, I had to be able to do my own research and find these things before the institutions jumped on them.
Yeah, this works. There was this management science article that came out, published that in the same market, with the same conditions, an average retail investor loses an equivalent of approximately $18,500, while institutional investors gain approximately $375,000. This is over the same period. So they're making great money, while the average person is actually losing money. So same time period, opposite results. So I think people might be really curious. I know I am. What are those professional traders seeing? You mentioned that they have tools, they're able to see some things and then they pass it off. What kinds of signals are they looking for? What are these triggers that's helping them make all that money?
What's really interesting is that the investment bankers actually have access to a lot of the same tools that you and I do. And that is especially true over the past 5 years. Over the past 5 years, the amount of tools that have been made available to retail traders, at this point, it's almost on par with what the institutions are seeing. So much so that the institutions aren't even using their unique tools that they once had access to that nobody else did, such as the Bloomberg terminals. Things have changed now where everybody has access to the same information. The major difference, though, is not so much in what information we have access to or what we're buying and selling. The big difference is when we buy and sell. And that makes all the difference in the world. The most basic summary form I can give you, institutions buy when stocks are beat down and sold off and nobody's interested in them. It's what's called an accumulation period in a stock. And that accumulation period can last for years, where retail has no interest in it whatsoever. Then once the stock starts to run up, it starts to rally. That's when retail starts to take notice and retail traders start to buy it because they get FOMO, this fear of missing out. They see the stock going up. It's already up 50, 100%. They get fear that they're going to miss out on future returns. So they jump in. And more often than not, they're jumping in near the top. And once that stock starts to sell off, institutions get out, they're taking their 50, 100, 200% profits, and retail has now bought at the top and the stock is starting to go down. Rather than jumping ship and cutting their losses early, retail tends to hold on. They don't want to take that loss. Even though they have the paper loss, they don't want to realize the loss. And so many times retail traders, they're just going to hold on that stock, waiting months or years for it to turn around to even break even. And they end up losing money on the exact same stock that the institution actually made money on, because the institution bought it when it was beat down, nobody wanted to touch it, and then sold it when it was rallying and everybody wanted to buy it. And retail did the exact opposite. They bought when it was rallying and everybody wanted to buy it, and then they end up selling after it's already fallen 50, 80, 90%. And so that's why very often retail traders will lose money when the institutions will make money. It's not so much about what they're buying and what research they did, it's about when they buy.
So they have the collateral and the leverage to be able to buy in. They're doing it when it's cheapest. They know they have the deep pockets to wait. They allow those retail investors to create that momentum that they can ride up and then eventually profit from. And they understand the psychology that might be hurting others and are able to kind of mitigate that. That's amazing. You mentioned Bloomberg terminals. A Bloomberg terminal costs $25,000 per year per user. They're super expensive, sophisticated things. And institutional firms will deploy these across entire trading floors. And then they have like proprietary algorithms and dark pool access and pre-market execution capabilities and things like that. It's really interesting. I was wondering, is that giving them an extra edge more than the timing piece? Maybe help explain what the Bloomberg terminal is and why they're investing in them since they're so expensive.
So the Bloomberg terminal is and always has been a tool with a lot of research tools and analytical tools built into it. But more importantly, it's also been a trading platform where the different brokers can actually talk to each other with their Bloomberg terminal chat. And that terminal chat is where the real value is. You know the old saying, it's not about what you know, it's about who you know. Well, in today's day and age, especially over the past 5 years, all of that proprietary information that was on the Bloomberg terminal is now available to retail traders. It's no longer proprietary. It's no longer something that institutions have access to that retail doesn't. And so really, especially over the last 5 years, retail's really caught up in that manner. But where the Bloomberg terminal still shines, and this is really what it's used for today, is terminal chat. It's used to talk to other brokers and other traders at institutions to decide what trades they want to make, to actually find people that have stocks that they can buy. Because as a retail trader, you want to buy stock, you just go and you buy it. You don't know what's really happening in the back end. Generally speaking, if there's enough sellers out there, you're going to buy from them. If there's not, you're going to buy from a market maker. But when you are an institution and you're buying millions and sometimes billions of shares at a time, you can't just go out to the open market and find those for two reasons. One, there's just not enough shares available. And two, if you were to buy that many shares at one time, you would artificially inflate the price of that stock significantly. And same when you get ready to sell, you would end up crashing the stock. And so you can't do that. And as a result, they use the Bloomberg terminals and terminal chat to find other institutions that they want to trade with. And then they place those trades on what's known as the dark pool, and it's processed on the back end through DTCC. And that is something that the retail traders still to this day do not have immediate access to. Obviously, we have no access to the Bloomberg terminal chat. And even the dark pool data, even though it does now get released, it's released 2 to 4 weeks after the trades are placed, which isn't real helpful.
Yeah, that's interesting because the dark pool data, at least when they're doing some of these trades, it's still the order size prices are hidden from the public market, like you said, for at least a while. How much is like the pre-market and aftermarket windows matter here? Because those are windows that retail investors are rarely using effectively, at least. Are institutions really taking advantage of that timing?
Some are, some aren't. It really depends upon the strategy of the firm. Certainly when it comes to earnings, you bet. They are absolutely taking advantage of the pre-market and aftermarket, because a lot of times you might wake up in the morning and it's 9:30 and you go to check your stocks and somehow magically they fell 5% overnight or they rallied 15% overnight. And what's ultimately happening there is some news came out, whether it's earnings or some other news, and the institutions have immediately jumped on that and they've bought or sold that stock. And by the time most retail gets around to checking, the move has already happened. And this is something that retail traders have access to, but they just don't really take advantage of, nor are they really able to, since your entire pre-market and after-hour trading hours are from about 4 a.m. all the way up to around 8 p.m. And you just can't physically sit in front of your computer from 4 a.m. to 8 p.m. and trade. Where the institutions have an advantage is they can hire multiple traders. They can hire one for the morning, one during the day, and one in the evening. And when you have multiple people all handling a portfolio, it becomes a lot more feasible.
So when you were at Merrill Lynch or you were seeing some of these things, what were you seeing that you were like, okay, I can help people here? What were some of the big first lessons?
I kind of used my time at Merrill Lynch and Morgan Stanley to learn. And I didn't really figure out like how I could help people until really that light bulb went off on me during that GameStop fiasco. Actually, it started earlier during Tilray. And seeing what people were doing at Wall Street Bets, that's when my mind started shifting from, all right, I'm just going to go trade for myself versus, oh, I need to start helping people. So
let's talk about the GameStop, because that was a huge event. I think a lot of us were fascinated during that, watching really kind of an outlier like we had never really seen before. So you had the rare experience of kind of watching this retail revolt. You were on the inside during that time. Is that right?
Not during GameStop, no. So I was on the inside for the Volkswagen Finishy squeeze and then the flash crash, which was caused by a retail trader, funny enough. 2008 financial crisis. I saw all of that. But during GameStop and Tilray, I was actually on my own. I was working for another company called Genesis Financial. We helped retail traders do algo trading at that time.
What was the institutional response like, since you were kind of seeing it from that side? Was people responding in a large way to it?
There is this really interesting thing that happened. So a lot of people have heard about GameStop and they know the GameStop story. There's been documentaries made about that. What a lot of people don't realize is that actually happened before, years prior, with a company called Tilray. And this was actually the first time that the institutions had to wake up and realize that market dynamics were changing. Because for the longest time, the institutions basically controlled the market and retail was pretty much just along for the ride. That all changed when the Tilray rally happened. And at that time, it occurred on Wall Street Bets. Today, Wall Street Bets has millions of people watching it. But at the time, it was only about 200,000 people. And those 200,000 retail traders all collectively, not on purpose, just happened to decide that they all wanted to buy Tilray. Because at that time, there was some belief that with Colorado decriminalizing marijuana and Washington State getting ready to decriminalize it, that these Canadian companies were going to be able to come in and start selling their marijuana products here in the US. And that was going to cause massive outsized returns for these companies. And so a lot of people in Wall Street Bets did that analysis. They decided to buy Tilray, and the stock rallied 200% in a very short period of time. And this got picked up on CNBC. And it was the first time ever that CNBC started to talk about retail traders controlling the market. And then that story kind of died down. And then a few years later, when GameStop blew up, that's when institutions finally said, okay, we can no longer ignore retail traders. We now have to look at what retail traders are doing, because in certain stocks, they're actually controlling the markets. And I actually heard from one insider, he told me that it had become such an important issue that Wall Street Bets was now in the training for the institutional traders on the Bloomberg terminals. That's how important it had become to the institutions. So we went from this place where retail was ignored and along for the ride to now today, retail traders are actually controlling the market on a lot of stocks, and the institutions are looking to retail, and the institutions are along for the ride. And that's been the most stark difference over the past couple of years. It's been absolutely amazing to watch.
Yeah, I mean, I've definitely seen some meme stocks grab momentum. That's really fascinating. Really wanting to ask you about options.
Let's use GameStop to transition, because that's where the story started. That's how everybody got into options.
Yeah, exactly. So maybe we should take a step back, actually, though, and talk about GameStop a little bit more for those who aren't super aware of what happened. And then I'd love to transition to options, because institutional investors definitely trade options in a very specific way, and they leverage it very well, typically on the selling side. But I don't want to jump ahead. So talk a little bit more about GameStop, because you did experience that as well. At that point, you had a lot of experience behind your belt. What were you kind of taking away from that?
I think the biggest stark contrast for me when it came to GameStop was the naked shorting. The whole reason GameStop blew up is because retail was looking at short interest, and that was one of those data tools that I told you was only available to institutional investors, was now available to retail for the first time ever. And retail traders looked at that and they said, wait a second, how is it possible for one stock to be shorted 124% of float? How can it possibly be possible that 124% of the total shares are being shorted? It doesn't even make sense. And retail looked at that, and I want to go back and kind of explain like how that occurs, because I actually had the benefit of working on the short selling side when I was working at Merrill Lynch. And what essentially happened is prior to 2009, a lot of companies were doing naked shorting. And that's essentially where if you wanted to short a stock, you have to go out and essentially borrow that stock from somebody else who already owns it so that you can then sell it. And if you don't know what short selling is, basically you've heard that you want to buy low and sell high. Well, short selling is just the opposite of that. You start by selling high, and then later down the road, you buy low. And so in order to do that, what you're doing is you're borrowing the stock from somebody who already owns it. You give them a percentage interest in order to borrow the stock from them, maybe 1 or 2 or 4% per year. And then you go out, you short the stock. Later, when you're ready to buy it, you buy it, and then you return the stock to the person that you borrowed it from. And that's kind of how short selling works. Well, what happened in 2008 is a lot of people were naked shorting, meaning they would try to find a stock that they wanted to borrow, and there weren't any shares available to borrow. And so they would just short the stock anyway. They'd just sell it, even though they didn't own it. And what happened is it caused a lot of stocks to end up having a short interest where there were more short sellers than there were actually shares in the overall market. Now, theoretically, that became illegal in 2009. However, it still occurs, and we realized that with GameStop. And what happened with GameStop wasn't necessarily naked shorting entirely. It was actually more of a recycling of shares. So the short sellers would sell those shares on the open market. Retail would buy them. Retail then have more shares available to short, and then the institutions would then borrow those shares. They would sell them, and then those shares would then become available to short. They'd get borrowed again, and it was the cycle where the exact same shares were getting borrowed over and over and over again until we eventually got to 124% of the total number of shares available being borrowed and shorted. And retail said, this is stupid, and we're going to punish these people for this. And they collectively all got together and decided to buy GameStop. And what ended up happening when everybody got together to buy GameStop is that the entire value of that share started to go up and up and up, because when you have more buyers than selling, price goes up. And as the price went higher and higher, as more retail was buying, the short sellers were starting to lose more and more money. And short sellers panicked, and they said, we need to go out and buy shares on the open market in order to close our short positions. And so they would go out and buy, and that caused the price to go higher, and then retail would buy, and that caused the price to go higher, and then more short sellers would close, and that caused the price to go higher. And it's called a short squeeze when you end up with this loop where there's just massive amounts of buying in a very rapid period of time. And people at that time thought they were going to have the quote unquote MOAS, or mother of all short squeezes. So they just kept buying the stock. But where things really, really took a turn and made all the difference in the world for retail, and this is what really made the headlines, is retail traders weren't just buying GameStop stock. They were actually buying call options on it, and they were seeing incredible returns, 9,000, 10,000, 20,000% returns. People were literally putting $100,000 into these call options and making millions of dollars off of the stock. At least they could have if they had sold. And that's where retail kind of screwed up. But it doesn't matter. We still took the win because the large institutions took massive, massive losses. Marvin Capital actually had to shut down because of it. And it was just one of those incredible stories that made headlines. Documentaries have been made about it, and it completely changed the entire trading game for everybody.
Absolutely. I mean, people still look for high IV and hope to profit massively on these things. I mean, see it all the time. So this hasn't stopped at all. I think people are looking for their GameStop moment for sure. But I wanted to ask you, because I was reading this paper about how institutions typically do multi-leg options. Like you mentioned, squeeze. A lot of retail investors still do simple options, one-sided positions, just a call or a put. Institutional investors typically are selling options rather than buying them, and they're really profiting well from it. I know retail investors are waking up to options and getting more sophisticated, doing better. So I was curious, like, how do you look at options today for retail investors?
I think it's multifaceted. So when you talk about selling options, generally when we're using multi-leg options, we're selling options. We're just using multi-leg options to do it. So to give a real brief overview on what options are, in case you as a listener aren't really sure, you may have heard about it, don't really know what they are. Essentially, they're designed to provide leverage on a stock. So with a call option, if the stock goes up a certain percent, the option should go up much larger percent. And a put option is the opposite of that. If a stock goes down a certain percent, the put option should make significantly more money. And so a lot of retail traders have that basic understanding, and they try to find a stock that they think is going to go up massively. And rather than buying the stock, they buy call options on it because they think, well, if the stock goes up 50%, I might make 500% on my option. And they're right if it were to occur. And on the downside, they might look for a stock that they expect to fall significantly, and they will buy a put option on that, hoping to make a massive profit if the stock does in fact fall. Where a lot of retail traders get confused is they don't entirely understand implied volatility. And basically what that means is when you're leading up to a major event, I see this a lot with earnings, the price of the option starts to get very, very expensive because people expect that stocks are going to move massively after earnings. And as a result of that, the price of the options start to price in this implied move in the stock price. And so the options themselves get very, very expensive. And more often than not, the price of the option is so expensive that even when the stock does move in the direction you think it does, it doesn't move enough to actually make money on the option. And as a result, even when the retail traders get the direction right with their option, they still lose money because of that implied volatility, because of theta decay, and a lot of other things that go into the pricing of options. So the question that I started to ask was, if 70 to 80% of retail traders lose money on options, who's making money? And I very quickly began to realize that if retail traders who are buying these options are losing money, the people making money are the ones selling the options to them. And I realized that if I flip the script and I start selling options to people, then I would actually make a lot more money. And that made all the difference in the world. And then from there, I said, okay, well, if I'm going to sell options to people and make money 70% of the time when they lose money 70% of the time, why don't we take it up a step? And I realized that with multi-leg options, there are certain strategies that you can implement in order to reduce risk. And you can literally get to the point where if you think about a stock, it could do 5 things, right? It could go up significantly. It could go up a little. It could go flat. It could go down a little, or it could go down a lot. You do one of those 5 things. And if you're just buying a call option, you only make money if the stock goes up a lot. You lose money if it goes up a little, flat, down a little, or down a lot. Put options the opposite. You make money if the stock goes down a lot. You lose money if it goes down a little, flat, up a little, or up a lot. And so with a call option or put option buying, you're only making money on 20% of the time. But if you then sell that option, guess what? You make money 80% of the time. However, there's a little bit of risk in that, because if I sell you a call option and the stock does in fact go up a lot, my losses could be substantial. It could wipe me out. And in fact, some institutions have been wiped out. And so multi-leg options, they reduce your risk. They put a limit to the amount of money that you can make. That also limits the amount of money you can lose. And so if I'm going to sell a call option to you, and I say, I don't think the stock is going to go up massively. It might go up a little, but it's not going to go up massively. I want to hedge that and protect myself just in case the stock does go up massively. I don't want to get wiped out. So what I'll do is when I sell that call option to you, I'm also going to buy another call option at a much higher price. It's a lot cheaper. And then my goal is basically to pocket the difference between the expensive call option I sold to you and the cheap call option that I bought. And that difference between those two is my profit if in fact the trade does not go up a lot. And if the trade does go up a lot and I lose money, my losses are now maximized. I'm not going to get wiped out.
So on the institution side, are there things that institutions are doing then? Because I know they're profiting a lot from being on the right side of options and on a lot of these trades. Are there things that they're also doing to kind of protect themselves from the implied volatility and large swings? Like, are they hedging positions the way retail investors do? What other things did you notice that they do that we can learn from on that side?
The biggest thing that I noticed is that retail traders don't really hedge their positions at all. And very oftentimes when stocks start to go down massively, they end up losing a lot of money. Now, I think the reason for this is because as a retail investor, a lot of times we're buying a stock and we know that the most amount of money we can lose is 100%. But when you're shorting a stock, it's very different. When you're shorting a stock, the most amount of money you can make is 100%, but the most amount of money you can lose is infinite. If you think about it, let's say you short a stock that's trading at $100 and the stock goes to zero. Well, you sold it at 100, you bought it at zero, you made 100% profit. But let's say the trade goes against you and you short that stock at $100 and then it runs up to $1,000. Well, you now sold the stock at 100, you bought it at 1,000, you have a $900 loss on a $100 investment. And so when you're shorting stocks, your losses can be infinite. And as a result, you have to hedge. You just have to. And one of the ways that a lot of the institutions will hedge when they're shorting is to buy call options. And retail now has access to see these large outsized options trades, and they mistakenly think that, okay, this institution just went out and bought a ton of call options. They must know something I don't. Let me go buy call options too. And they don't realize that it's actually a hedge against a short position. And the institution's expecting the stock to go down, not up. And so what I think a lot of retail misses is that a lot of times they see these massive trades being made in options and they think it's a belief a stock is going to go in a certain direction when it's actually a hedge against a belief it's going to go in the opposite direction.
Sleight of hand.
Yeah. So a lot of times when we're looking at these large outside options trades, I ignore the single leg because I don't know what they're actually doing. What I'm looking for is the multi-leg. I'm looking for the ones where somebody bought a ton of call options at one price and sold a ton of call options at another price. I'm saying, okay, that gives me direction. Now I know what they're actually thinking. And so the hedging a lot of times is done with options, especially when you're shorting the stock. Now, on the upside, there's not usually a lot of hedging that's taking place. If there is hedging, it's done with another stock with a different company in the same industry. So, for example, somebody might buy Verizon stock and short AT&T stock, and they kind of do hedging that way. That strategy called a long short strategy is something that isn't super effective, but a lot of people do it just to hedge in case they end up losing a lot of money on the stock. At least they're going to make a little bit back on the short position. And that's something that institutions do. Retail doesn't really have to worry too much about that, especially if you're only buying stocks. I think what would actually help retail out more is closing out those losing trades quickly rather than bag holding and just hoping and praying the stock turns around, because a lot of times it doesn't.
Scott, I'm sure there are people listening who are like, this is great, but what do I start doing today? I'm not a professional. I'd love to have more professional discipline into how I'm trading options or how I'm trading my stocks. But how do you generally help people get started with some of these things? Where would you start to guide folks?
I would tell people to start with my YouTube channel at Stock Curry. And from there, if you don't want to learn video by video, maybe you just want to dive in and just get all this information right away, I put together an entire course with everything that I learned at Merrill Lynch and Morgan Stanley, as well as full options trading. And people that go in there, they find that they're learning information they didn't even know they didn't know. There's just so much information out there. And that is available at weprofit.io. Now, if you're a little bit more experienced trader, you already know options and you just want to learn what professional traders are doing and how they're making money. I also have another community called Stock Dads where I show you from over 20 full-time professional multimillionaire traders exactly what they're buying and selling as they buy and sell so that you can copy their trades and learn from them. Again, that's all available at weprofit.io.
Thank you so much for coming on the show. I really appreciate you sharing your insider wisdom and answering all those questions, and best of luck continuing with all your trades.
My pleasure. I really appreciate it. I sincerely hope that you as a listener will jump on board and learn so that you can make those kinds of returns as well.
I stumbled my way through trading. I bought high, I sold low. I bought calls and lost money. I've even had my covered calls get crushed by IV and had my shares assigned less than what I could have made just by sitting and waiting. It just hadn't occurred to me that it could be that complicated. You know, it's a transaction. You're buying something that shows value and then you cash it in to realize that value. Yet, like Scott said, there are two sides to every transaction. Meaning someone is always coming out on top. Take options trading, for example. I had bought calls hoping to profit on what looked like undervalued companies. It seemed really straightforward. Someone sold me those options, meaning that there was a person or a professional institution betting the other way. And when the stock didn't rise, I ended up being the loser. And that left me scratching my head to where it all went wrong. What information did they have that I didn't? Were they just more lucky? And as Scott explained, institutions have access to information earlier and throughout the day, and that makes it hard for retail investors like me to compete. A single Bloomberg terminal costs $25,000 a year. It gives those professionals access to research data and, most importantly, other professional traders. They can trade information on the inside, making moves before it's priced into the stock. With deeper pockets, they can create real momentum, pushing a stock up, short selling one down. This causes retail investors to jump on because, let's be honest, the fear of missing out can be too powerful to ignore. Sometimes those trades aren't even what they appear to be. Take put options, for example. So people buy put options because they're certain a stock is about to fall. On the other side, though, is someone gladly selling them that put. And that someone has already priced in that exact fear that made the bet feel obvious. So the cost of betting on the crash gets baked so high that the stock can genuinely drop. And you could be right about that. You could be in the right direction and you could profit from it. But like Scott said, a stock can move in 5 directions. So when you're betting on a single direction, in this case to fall far below market price, the odds can really be against your purchase. And it can even be more confusing the other way around. As retail investors, we might see the momentum from a giant block of call options. And it's natural to think that someone knows something and that we need to jump in before the stock skyrockets up. So we pile on. But as Scott explained, a lot of those institutional calls are not a bet that the stock will rise. They're actually insurance. When a big firm shorts a stock, betting it will fall, it will often buy calls to cover itself in case it's wrong. It's basically betting both sides. It limits as far as they could profit, but they're mitigating the risk of a massive loss. But we can read those signals wrong. So the signal that screamed, get in, it was actually a hedge on a bet that the stock goes down. So the crowd can read it backwards. But the good news is that all that information that institutions have is now more publicly available than ever before. And that gives us retail investors the advantage to act and benefit like professionals. The strategy is pretty simple. The institutions buy when a stock is beaten down, boring, and abandoned. Then they sell it back once it's exciting and the whole world wants to get in. But as retail typically is proven, we will do the reverse and we'll end up holding the bag. We show up late, buy the excitement near the top, and then when it turns, we hold the loss far too long, hoping for a comeback. Behavioral economists have a name for this last part. They call it the disposition effect. It's our deep, almost physical reluctance to sell a loser and admit that we were wrong. Terrence Oden documented it decades ago, and has been quietly draining accounts ever since. So for stock trading, flipping the script can make all the difference. Do the research, find those undervalued positions, and get in to benefit from the rise. And most importantly, not sitting on the shares when the drop occurs. Don't want to be one of those temporary, overnight multimillionaires like so many of those GameStop investors who sat on the rise. Like Scott, I came to the same conclusion when it comes to options trading. I no longer buy options, I only sell them. Management Science published a landmark study that found that for everyday investors and giant institutions alike, the single most successful strategy was not buying options at all. It is selling them. Selling an option is, in plain terms, selling someone insurance. Collect a premium up front, and most of the time, nothing dramatic happens. You just keep the money you made. It's that simple. The catch is the rare day that the storm actually hits. That big bet pays off for the other side. And that day can be brutal if you haven't protected yourself. This is why the multi-leg options can really make a big difference for a more sophisticated options trader. And it's why the institutions do it. Today, selling options is part of how I generate cash flow in early retirement. And I'll be honest with you, it has been quite good for me. But I have to be careful saying that part to you because it sounds like a cheat code and it's something that might make you think, oh, that's great. I'm just going to jump in there and start doing that myself. And I'll make a bunch of money and I'll shortcut my plan. And look, it can be quite lucrative. And it is one of those things that absolutely should be part of your plan if you're going to put the right effort into it. But if it's done carelessly, it can wipe you out. The same way Scott watched whole institutions get blown up. It took me years to study it and a great deal of patience to learn to do it right. And I made some mistakes along the way. And I'm still learning. But if there's one big takeaway from today, let it be this. You don't have to beat Wall Street to be financially free. Financial freedom was never about out-trading the insiders at their own game. Almost everyone who reaches it gets there the unglamorous way, by being the patient, boring, consistent investor. If you enjoy trading, that's great. The tools are out there, and with the right education, you can chase that higher return. But you don't have to do that to complete your Escape the Clock program. Just invest smartly, allocate to the right account to minimize things like tax drag, and aligning your positions to your goals is enough. Follow the strategies in the book. Talk to the professionals. Let the growth do its magic. I'd love to hear from you. What are your trading strategies for financial independence? Email me at contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thank you for listening and best of luck on being on the right side of your trades and escaping the clock. See you next week.
That's a wrap on this episode of Escape the Clock. Everything you've heard today is for educational purposes only, designed to help you think, plan, and build a stronger financial program. Take what resonates, bring it into your Escape the Clock plan, and review it with a qualified professional before making any major moves. I'm Daniel C. Rogers, a wealth management certified professional and your host. The book, the free planner, and the one-on-one time with me are all waiting for you at EscapeTheClock.com. If this episode was valuable, please leave a rating and share it with someone who needs to hear it. I'll catch you next week.